Okay, so let's have a look at the 2019 revaluation question for Kilmartin. So this is the question here. I'll let you have a read of it yourselves and you can pause it and have a read of it. And then we'll tackle the question then. Okay, so the first thing you have to do is draw out your table. And your headings for this table is going to be the year, land and buildings, land, new buildings, and total. Land is going to be separated because land is not depreciated. And usually in the question, we buy a new building or we build a new building. And then down along the year side, you're going to put in the years as the question. Or you're given the questions like 2014, 2015, 2016, 2017, 2018. So each one of those years go down along the side here. Next thing we do then, we need to fill in the table with the value that we have for land and buildings, land and new buildings, depending on what happened in that year. So to start it off, we take the information from the start. So it tells us on the 1st of January 2008, they purchased a new building for 480, consisting of 80 for land and 400 for your buildings. So in here, we're going to have the total for 180,000. Your land is 80,000, and your land and buildings, or your buildings, probably make more sense. That would be, your buildings would be 480,000. So what happened then is on the 1st of January 2014, they revalued the property at 620,000. So the total is going to be revalued to 620. Of this revaluation, 120 was for land purchased on the 1st of the 8th. So this land that we have up here, 120 is going to be revalued. So in here, we're going to have 120. So that's going to leave us 500 then for your buildings. So that's a revaluation of 100,000. And here, revaluation of 40,000. So your revalue is going to be 140,000. So 140,000 is going to go into your revaluation reserve account when we come to do it. The 600 or the 480 is going to be your opening balance in your land and buildings. And then you'll have 620 then is going to be your new balance that you're going to bring down to next year. And the difference then will be 140, which is your revaluation figure. Then we have to calculate the depreciation. So depreciation looks like this. So on the 1st of the first 14, we had 400,000. That's this figure here, which is our buildings taking our land away from it. Multiply by 2%, you're going to get 8,000. Now in the question, it tells us that it is company policy to charge a full year's depreciation year of acquisition and no depreciation year of disposal. So we have this for 2008 is when we had it. So we have it up to start with 2004. So you got 2008, 2009, 10, 11, 12, 13. So it's going to be 6 years accumulated depreciation. So when we take the 400,000, we multiply by 2%, we're going to get 8,000. That 8,000 we're going to multiply by 6, and that's going to be the opening balance in your accumulated depreciation. The next one then at the end, we have 500,000 multiplied by 2%, and that's going to be depreciation for this year, which is 10,000. Then we move on to the next one. So in 2015, they purchased a new building for 130,000. So in here, we're going to have 130. And then what they do with it is they paid 500 to a building contractor and 2,500 for wages. So that needs to be added on because it's a new building. So 500 plus 250 or 25,000. That's going to increase the value of our new building. So it's a new building, so you can add these back on. So 130 plus 500 plus 50 plus 25. So the total value of our new building is 205. Nothing else happened in that year. So we also have another building of 500,000. And we also have our land of 120. So next thing we have to do is to calculate the depreciation on the two buildings that we have and the value of it. Remember, land is not depreciated. That's why we separate. So we're going to have 500,000 multiplied by 2% is going to give us 10,000. we've 205,000 multiplied by 2% is going to give us 4,100. So the total depreciation is going to be 14,100. Now we separate them because later on we're going to sell one of these land. So we're going to find out what is the depreciation for that land. So instead of having the total and getting the total depreciation for everything, we're going to separate and just get them individually. So our total balance then, when we come to do our land and buildings account, will be 825,000. So in 2016 then, they sold for 170,000 land, which cost 80,000, but it's since been revalued on the 1st of the 1st, 2014. So this land that we have here was revalued. So that figure, we're going to reduce it by 120,000. So you're going to open up your disposal account. You're going to put on the debit side 120,000. In your land and buildings, we credit 120,000 because we're getting rid of it. And then we'll also have this figure, 40,000. We'll come up with a revaluation reserve and we'll go into the revenue reserve. I'll explain that later on when we get to those that question. Okay, to spend 10,000 in respect of repairs, so you're just going to set up a repairs account and you're going to debit it by 10,000. So what we've left then, we've got 50,000 or 500,000 of land and buildings, and we've got 205,000 in our new build. So we need to get the depreciation for those two. So depreciation then for 2016, we'll have 50,000 or 500,000 multiplied by 2% gives us 10,000. And we 205,000 multiplied by 2%, which gives us 4,100. So it's a total of 14,100. In 2017 then, so the revaluate buildings owed at 846,000. So your total is going to be 846. At the start we had 205. That's going to increase by 10%. So it's going to be 205 multiplied up by 10%. So that's going to be revalued. And then we've got our 500,000. It's going to be revalued at 10%. So 2017 revalued, sorry, 20% increase. So it needs me to multiply that by 20%. So multiply by 20%. So when these two add together, they should give you 846,000. And then we have to find the depreciation for these two vehicles, or these two. So you got 600,000. You're going to multiply that by 2% to give you 12,000. And you got 246,000. You multiply by 2% to give you 4,920. You're going to add those two together to give your total figure. And then the last part then, sold for 225, the building purchased and extended in 2015. So this building here that we purchased, we got rid of it. So in here, so the value is 246. So you're going to minus 246. So that's gone. And then 60,000 is going to be left. So we're going to get your depreciation then for your 600,000. I've looked back at the question. The remaining buildings was revaluated at 715,000. So 600,000 will go in here. 715,000. We find the difference between the two, and that's going to be a revaluation. And that will be used later on to go into your revaluation reserve and your revaluation account. So our buildings then at the end are going to be 715,000. And then we define the depreciation then for this year, which is 700,000 multiplied up by 2%. So you get 114,300. Okay, so a couple of things then just for yourself. So the revenue reserve that you put in for this building that we sold. So we sold the building here. The revenue reserve is going to be the 41,000. That's the value of the increase, plus the 205 and this depreciation here. So that's going to increase the value. So that's the revenue reserve that I need to put together to add up to find the total figure, which is going to be 49,200. So that's going to debit your revaluation reserve, credit your revenue reserve. And then just for yourself, then you'll have two revenue reserves. So the first one was when we sold the building or the land for 40,000, and the second one then is this 49,200. And then the revaluation reserve, when we debit the revaluation reserve from our land and buildings account, the first one was 140,000. So that's the first revaluation we did. The second one is this 141,000. So this we revalued in 2017, 100,000 and 41,000. So the total that went to revaluation is 141,000. And the last one then is when we revalued in 2018, 115,000. So each one of these years, when we do it, in your revaluation reserve, on the credit side, you have two figures. You have one figure for the revaluation, and you have another figure for your accumulated depreciation. And that will make more sense when we come to transfer these into T accounts. So a couple of things with this. So have your names across the top for each of your accounts, the years, find the depreciation. So just calculate the depreciation here to the side. Remember, we have to calculate the cumulative depreciation, and that's done when we do the very first transaction or the first calculation. A couple of figures that you need to identify: the revaluation reserve. So you can highlight these in different color pens for yourself, or a highlighter. The best thing to do is highlight those three. And then your revenue reserve, then make sure you're able to calculate the second revaluation reserve, revenue reserve. And that's usually the revaluation figure plus any depreciation for that asset. So we've did in 2015, we'll have it in 2016. The question says we don't do it in the year we get rid of it. So no depreciation at your disposal. So that's why we only have two of them. So these two depreciations need to be added back on to the increase in the valuation that we had here. And you're going to add those three up to give you your new revenue reserve that goes into your revenue reserve account and the revaluation reserve account. And we'll look at them in the next video.